Welcome to the Power Exit Podcast. This show is dedicated to business owners who want to scale up, plan smarter, and prepare for the ultimate exit. We'll talk with M&A experts and owners who've been through the process to provide actionable advice so that you can sell your business on your terms and without regret. I'm John Marsh. Join me as we prepare to take control of your exit. All right, welcome to the next episode of the Power Exit Podcast. I'm thrilled to have Grant Edwards, who's a friend and a fractional CFO on the show today. Grant and I met in a previous life. I was the CFO at a coal mine, and Grant came in and took over that CFO role so I could do other opportunities. So we enjoyed working together. It was a little stressful in a startup, but we learned a lot and became buddies. So Grant, thrilled to have you here. If you wouldn't mind, just tell us a little bit about who you are, who Grant the CFO is, and what you do for business owners.
Got it. Thank you, John. I appreciate you having me. So my name's Grant Edwards. I am a fractional CFO based in Atlanta. I've been doing this now for about eight years. Prior to that, I was in accounting. I came up through the accounting ranks. Worked on Wall Street for a few years, and have been here helping multiple businesses prepare for an exit, successfully exit, and then move forward into a better life for a lot of the owners.
Yeah, wonderful. And that's why you're here. I mean, not only are we good drinking buddies, but it's the goal of this podcast is to provide valuable insights to business owners. And you've been through it. You know that selling a business is not easy. You've got to get it right. So, you've worked with founder-led businesses, private equity groups, family offices. Can you give us a quick overview of your background, what type of work you do for these businesses, and what type of businesses you typically support?
Sure. So I normally join these companies for various reasons. Number one, either they're ready to exit, or they have taken in a large equity player, and they need someone that's not been in the business to bring them that objective piece. You look at a lot of accounting firms, a lot of bankers, they're in it for transaction-based stuff. I'm emotionally invested in the business from day one. I'm your friend. It's like going into court. You always want to have an attorney. Going into running your business, it's good to have that impartial person that's there to lay the facts out there, that doesn't have separate motives other than seeing you be successful. And I've been doing this now for companies and pre-revenue all the way up to around 300 to 400 million a year in revenue, doing various stages of the business.
Yeah.
One of the things I've learned is that regardless of the size of the business, the goal is the same. The goal is to maximize your value, allow you to understand what you've done from your business perspective, and take it to the next level. Enjoy some of the success that you've built over your tenure as a business owner.
Yeah. And, anybody who's listened to this podcast will hear me say the same things over and over. You've got one chance to get this right. And a lot of the reasons that businesses or deals fall apart is because the financials don't withstand the scrutiny that a buyer is going to put them through. But before we get into that, I want to hear a little bit about what drew you into the fractional work. Obviously, you're there to help these business owners, like you said, kind of maximize their exit, maximize the value, get it right. But I'd imagine that's not a long-term engagement. So tell me a little bit about, what drew you to the fractional work and why specifically those businesses that are looking to an exit, because that's a shorter-term engagement than I would think, just being there without an exit imminent.
Right. So what I found in corporate world, it was you're driven off of getting a paycheck. You're driven off of taking your business, and you're always fighting for the next promotion, or you're fighting to, making decisions that are in a 1, 2, 3 year cycle. And when I got into business, I wanted to make a difference in business owners, into making the world a better place, doing what businesses in my mind are supposed to do, which is provide value to the world and not be worried about looking over my shoulder on a 2 to 3 year cycle.
Yeah.
And so that's why I got into what I was doing. I loved being in the entrepreneurial world, helping create that platform. A lot of business owners that I come across, they either built the product or they sold the product. That's what they did. So why do you want to get bogged down into building the platform, worrying about HR, worrying about accounting, making sure your books are right, talking to bankers, talking to insurance agents? bring someone up like myself that does it nonstop and has the expertise so that you as a business leader can go out and do what you love to do, which is make your customers happy, improve your product, make things in a better light. That's and that's what I found in my niche is let me build that platform for you. Let me provide value, cut costs where we can, present you in a way that you can maximize that cash out in the end with the right buyer. And you talk about buyers and what do you want to do? This is your business. This is not someone telling you what to do. My job is partly to help guide you through that mental capacity and that mental decision making.
Yeah.
And it's when I take a client on, there's really three things I look for. Number one is do you have the people around you to be supportive?
Yeah.
And that's your home life, that's your friends, that's your spouse. Are they believe in what you're doing? If you being a business owner and starting a business has its mental challenges, you are going to feel alone at times. You're going to feel in a mood where you feel trapped. And is that support there behind you? Yeah, it's John. I think you had told me when you had started in your business, your wife was folding up letters and putting them in the mail and helping you drive business. That's great. She's part of that success for you.
Yeah.
I can tell you, I made a mistake. I wanted to be an entrepreneur and I started a restaurant. My wife told me not to do it. She said, "Don't do it, don't do it, don't do it." It, it that business didn't hit its max potential, partly because I didn't listen to the people closest to me. And I had that mental challenge. So that's one of the questions I normally ask a client before I take them on is, what is that home life like? What is your friends like? Do you have that there to help mentally push you through the challenges of starting a business?
Yeah.
I think, and then, yep. And
No, that's exactly right. And business owners underestimate the amount of emotion that goes into this process. You're putting your baby up for sale, right? You're trying to find the right buyer to shepherd the business into the next phase of growth, the next phase of that business, and that's a hard thing to do. And it's challenging for those business owners who build an echo chamber around them. Just someone who they hear what they want to hear and tell them what they want to hear. The yes men, proverbial yes men. That's not what makes this successful. It's those who are around you who can help you weather the emotional roller coaster that is transacting. And, you know, that's part of the reason I wanted you on the podcast is because you do this. You do that specific for exits. So, you've seen businesses on the inside before and post exit. What are the financial traits that are specific to the businesses who are quote unquote exit ready? What do you see that flips that switch that says, oh, these guys might be ready to transact?
right. So you're looking for a revenue growth model. Is it building? And if it's not building, what's going to help it build? When you bring money into a business and when you're selling a company, that's what you're doing. You're bringing money into it, regardless of what your role is in your business post investment. Because in my mind, it's an investment that a buyer is making, not necessarily an acquisition. And you've got to decide before you go in that route also, what do you want your role to be post acquisition? Do you want to stay engaged, or are you looking to take time off and go to the beach? But you're looking for that growth and upward spiral. And why have you plateaued, or why is it, what few things can you tweak in order to give it that hyper growth period? Yeah. Is it, there's a company now that I'm working with, phenomenal company. Their revenue is fairly flat, but they don't have money in their sales their sales team. They've built a great product, but haven't built the sales side. So when we're looking to take them to market to find an investor in bulk, that's the first thing we're going to point out and say, hey, with you dump in sales and marketing costs, we know this product's going to go through the roof. I'm more concerned about revenue than I am about EBITDA. Because in buyers today, and your high multiple buyers believe that they can come in and make a few changes, find synergies with other businesses they own.
Yeah.
They can cut some G&A cost out, and make you profitable. But what they can't do is show you a route that A, your product is viable, and B, you have a demand for it in the place. So that's the first two items you have to be able to show. I had one guy, he talked to a entrepreneur one time. He said, "Go sell your product before you build it." Meaning, go make sure that you have people that are going to buy this if you build it, rather than sink a lot of money into it.
Mhm. I like that. Yeah, one of the things we try to do is articulate that growth story. What's next for the business, even if that owner is not involved? If, like you said, they're looking to retire and go to the beach, buyers like it when an owner is also willing to roll equity and be a part of that growth story. But either way, it's important to articulate that and show it. So I agree completely. Thank you for calling that out. Let's switch gears. You hit on it a little bit. So from a CFO's perspective, what do buyers look for that owners often overlook or underestimate from a financial perspective?
Buyers are not going into a company looking to reverse course. Buyers are looking to put money into it to take it from moderate growth to hyper growth. They want to see that they're investing in the future, not the sins of the past. And that's one of the items that you have to make sure you can show in your financial. Every entrepreneur, every business owner can sit back at the end of a year, end of 2 years, end of 3 years, and point to things that they did that were wrong, or mistakes that they made in the process. That is okay. If you can show what those are and show that you would be profitable if you didn't make these bad decisions, and still show the growth in revenue, a buyer can get comfortable with that concept. And showing those synergies and showing the things that you could pull out to make yourself profitable is very important to a buyer, because they're going to take your knowledge, take the mistakes you made. And what they're paying for is also some of those mistakes. So they know they're not going to turn around and make the same mistakes that you did. And then again, get you to hyper growth so that your buyer can get the return on investment.
Yeah.
Because at the end of the day, that's what's driving it. You're the one that was emotionally invested in your business. Most buyers are now looking for a return on investment, not necessarily wanting to make the best coffee or wanting to uh, eh, drill more coal or looking to make the best t-shirt. They've let you be the one that has the passion in your industry. Now they're saying, how can I get my money that I'm going to pay you plus multiples back?
Yeah, that's exactly right. They're looking for a financial return, regardless of what that business is. It's all about a return on their equity. So, how do internal finance teams and reporting systems need to evolve as a company gets closer to a transaction?
Well, again, the first is fully understanding your investments and which things are you spending money on. Yeah, I don't like to call it cash burn. I like to call cash investment, because you're investing in the growth of your business. Identify the ones that are not needed. In the event that you sell your company, are you still going to be involved, or is your salary an add back? Is your salary something that they're not going to have to pay anymore? A lot of investors or a lot of business owners will have mud in their numbers. They'll have where they're paying a kid to do stuff. They're paying their child a
Sure.
salary to help keep the computer running, or they will have vacations that they've ran through. I think my favorite was the business owner that had a President's Club trip every year for their top sales rep. And I was like, well, that's you. Right? And he was like, yeah, it's my President's Club trip to my family vacation. Those kind of things that if you can point those out to a potential buyer, it increases the value of your ROI. So when you go in, most companies are not going to have audited financial statements. They're going to have QuickBooks, P&L, balance sheet. They're going to have tax returns. They're going to have bank statements. They're your three starting items. From there, you're depending on the size of the acquisition, you'll go through a quality of earnings process. And that is when it's very important to have an objective-minded CFO walking the auditors through the quality of earnings to help identify and pull out synergies to make your numbers pro forma perspective, look much, much higher. And that, again, by pulling out the mud and the mess out of the financials that aren't going to be there. You also want to look at receivables. Do you have clients that aren't paying you? A buyer is not going to give you credit for old receivables. So you want to go track as much of that cash and get it in your business as soon as possible.
Yeah.
Next thing you want to look at is inventory. Do you have obsolete inventory? What do you need to do to keep that inventory from being obsolete? It's all about the current perspective of the business when you go to be sold. They don't want to pay for the sins of the past. They want to pay on hyper growth for the future.
Yeah. Well, you've hit on something a couple times in your comments. One is, and it's adjusted EBITDA, right? There are you call it MUD, the add backs, those discretionary, non-essential expenses that are running through the P&L. And if you don't capture those as a seller, the buyer's not going to give you credit for them. Like you said, they're going to do a quality of earnings. They will identify those, but they're not going to share them with you. If you find $500,000 of add backs and there's a 5 times multiple on that, you just left $2.5 million on the table. So it's important, like you said, to go to market with financials that if there are sins in there or mud, that's okay. As long as you call them out and they can be defended through diligence, you can get credit for those. And it's really important to go into it with that mindset. A lot of folks don't build the team. They take a proprietary deal and they leave a lot of money on the table. So
and they're emotional because it's their child that they're trying to sell. They put all that love and emotion into growing that business, and it is a psychological deal to go through the process. And that's why you need someone like John and myself to come in and walk you through that and be on your side of the table. We've been through this thousands and thousands of times, and it is almost like a game of chess. The buyer is looking for any way they can to talk down the purchase price, and you've got to have the non-emotional, calm person on the other side of the table that's trying to talk up the valuation.
Yeah, and who could do it
with their experts, not to steal a line from one of these some of these class action attorneys when they talk about these insurance companies and they have powerful lawyers on the other side of the table. A lot of buyers are expert buyers and they know the levers to pull. So you want to make sure you have an expert on your side of the table, fighting for every last penny you can get your hand on. You get one shot.
One shot. And, a lot of folks say, oh, well, Grant costs money. John costs money. But I have not left a deal where I felt like I didn't pay for myself, or we didn't get either an increased purchase price, better terms, oftentimes both, so that we left the transaction feeling like we provided value. So same with you, I'd imagine. That
you don't buy a house without a real estate agent. You don't sell your business without experts on your side of the table.
100% agreed. So Grant, you've worked with a lot of different types of businesses, founder-led businesses, private equity-backed businesses. What lessons have you seen from each side when it comes to preparing for an exit? I'd imagine those private equity-backed businesses have more scrutiny on you and the financial mechanisms of the business versus those that are bootstrapped founder-led businesses. Can you talk to the audience a little bit about the difference there from the private equity-backed businesses to the founder-led businesses that you work with?
Sure. So there's really 3 or 4 different types of exits that companies go through. It's the most common one that people talk about where they see the large multiples are really one of 2 boats. It is a private equity led acquisition. And then the other is the IPO, which we won't talk much about the public offering model on this podcast. It's a more compliance driven exit as opposed to a private equity, which is more of a growth driven exit. And a lot of times you'll find that the private equity guys are experts at managing money and looking for efficiencies, but they may not understand your industry. And it's key in those situations that you can also talk about the specifics of your industry and how that works. Revenue recognition is a good component. It's in the software space, you recognize revenue over the subscription period. While certain industries may be cash-based and at the point of sale transaction. And understanding that and the collectability of receivables is key. For one good example on the technology side, and private equity looks in this, is most business subscriptions are paid annually. So the buyer is going to immediately realize that you've already collected 12 months of revenue, even though they still have to do 9 months of work. So that's the first thing, is making sure that the buyer truly understands how your business operates and how your financial statements are there. They're going to ask for certain things. First step they're going to ask for is your income statement and your your bank statement or balance sheet. They're your first two items. They'll look at your tax returns. They're going to speak to your customers, and you want to make sure that everything you give them ticks and ties. They've got phenomenal spreadsheet analysts behind them doing the diligence. Yeah. And their whole job is to make their personal careers look better by making you look silly. And they're going to run your financials through the process. The other thing to consider is, what is the private equity going to do with your business? Are they looking to bolt you on to another entity that they already own? Or are they looking to set you up as a platform that they're going to then add on additional bolt-ons down the road? Yeah. Or are they feeling they can dump a bunch of cash into your business and you be able to put you in a situation where you're going to hyper grow your sales team? They're the typical three routes. One of the things you have to decide as a business owner is, what do you want to be in this business post-acquisition? Yeah. Because we're also going to negotiate for you your employment agreement or your period of time which you provide guidance. Are you going to be on the board? Are you going to stay on as CEO? Is there going to be an earn-out period? There are so many elements that are in there that have to be negotiated for you as an individual. You're most likely going to have an earn-out period with a private equity-led business, meaning that if the revenue of your business declines after acquisition, you will not collect all the purchase price down the road. Yeah. So you will have some incentive to make sure your revenue stays where it's at. The other spectrum is what's you're calling a founder-led acquisition. In a founder-led acquisition, they're most likely going to understand your business, and they're looking to diversify their current business model by picking you up. They're going to approach it more so in how they're going to find synergies to eliminate your G&A cost while keeping your revenue where it's at. So again, as an owner in those situations, you've got to step back and say, okay, how am I going to do my maximum return on the business, and also take into account, your employees and what that means for them post-acquisition. Because some founder-led businesses, a few private equity, not really, but most founder-led businesses are probably going to reduce your headcount of your employees and combine jobs. My favorite line by private equity going into or in some founder-led business, when they do an acquisition, nothing is going to change. That stays. That's true for the first 6 hours. And then they're looking to push you into format. No one buys a business with the goal of keeping it flat. Their goal is to try to grow and expand rapidly. So take those into consideration when you're going through the diligence, when you're going through the sale process. First, what your role is going to be post-acquisition, and two, what's it going to mean to shaking your business and your long-term earnout potential?
Yeah, I like that. You're right. I mean, I'm sure you have too, been in businesses that were acquired, and that 100-day plan, post-acquisition, is intense. They're coming in and they are going to make changes. Now, that doesn't always mean they're going to fire employees, but they're absolutely not going to keep low performers on the team. Oftentimes they're going to bring in some more seasoned executives to supplement or even replace who you have already on the team. So to your point, you've got to go into this eyes wide open, know what to expect. You touched a little bit on kind of how you onboard and interview clients. We do that as well, because if you're not emotionally prepared for this transaction, we're probably not the right solution for you. A lot of business owners think that they're just going to sell their business and be in charge, and it's going to go the way they say. That's not true. You have to show a little bit of back and forth, some negotiation and flexibility within reason. And that's where experts like me and you help them help owners determine what's acceptable and what's not.
And one of the things I like about working with John is that we're both of the same mindset. We're not going to take a client on that we can't be effective for and that we would be hurting the business. We want you to be successful. It doesn't, we don't want you going out after the transactions and I can't believe what Grant and John did to my business and how miserable it was. We want you out there saying, it was a pleasant to work with these guys. I was able to concentrate on my business. They ran the parallel side. They helped me expand and get a higher value. And, next time I have another business that I start, because the best indicator of a successful entrepreneur is one that's already been successful one time. Is
Right.
we want to stay friends for life. And I value the friendships that I have with clients just as much as I value the business part of the job.
Yeah.
John, I'm sure you do as well.
Yeah, it's more than a commission. And my structure is a little different, right? Because we work on a success fee, so we have to say no if we don't think we can help this client sell their business. It's just not good business decision from our standpoint to work with someone who's going to not transact. But it's important to suss that out at the beginning of a relationship and not after you've already done the work. Um, so Grant, a couple more questions for you before we break here. We haven't touched on owner dependency. So what's your take on reducing owner dependency from a finance perspective, and how do you help owners, quote unquote, fire themselves operationally without letting the business lose control?
That's a great question, John. It is one of the most challenging things for everybody is to learn to rely on other people. But you don't have a business if it's solely on you. No one wants to buy. I mean, you started your business because you didn't want to have a boss over you 24/7.
Yeah.
So if you are the whole business and you want to have an exit, well, guess what they're buying? You.
Yeah.
So you've gone to identify. I like to identify the opposites. The most successful relationships I've had over the years, both with bosses and with subordinates, is people that are opposite of me. So that you're feeding off of each other and you're learning from each other and you're getting in a position that you're able to rely on them to bring something different to the table while transitioning transitioning the stuff over. Number two is keep the relationships. Salespeople love to keep relationships for themselves.
Mm.
You can't do that if you're trying to sell your business because you want that revenue to stay there. Look at selling. When you sell your business, consider it the biggest commission check you've ever got because you sold all your customer leads in the process.
Yeah. Yeah. And that's a great point. We don't want your cell phone ringing. I'm sorry to interrupt you, Grant. We don't want your cell phone ringing. We want the company line ringing or your salesperson's phone ringing when it comes time to take an order. Sorry, I cut you off.
Not every problem. You don't need to solve every problem.
Yeah.
And that's part of my function as a fractional CFO is forcing you to say, hey, I don't have to process payroll every week. Somebody can do it for me and my employees are going to get paid. I don't have to watch my bank account every week because I know if I'm going to hit a cash trough. You're learning to rely on other people that can keep the business moving and you can concentrate on the stuff you enjoy.
Amen. Yeah.
And always keep in mind, the one thing I always tell myself is life has an amazing way of working itself out. So if you're scared to be replaced, don't. You can reinvent yourself. Life has a way of figuring itself out. Don't be scared to rely on your team to help grow your business. You can work constantly on the strategic side and create and keep. I mean, you're investing in them and their future career, and that feels good too when you see somebody that you hired become successful.
I love it. That's great. Thank you. So a couple more questions for you, Grant. And if a business owner is a couple years out from selling, what's the one action other than hiring you? What's the one action they should take right now to get financially ready?
Is every single dollar they spend needs to do one of two things. It needs to grow revenue or increase efficiencies.
Mm.
That's where you go. You are now trying to build a repetitive process and a cash machine. 1 to 2 years out. I'm not saying stop developing, but I'm saying really focus in on what the core value of your business is that you're going to expand. All your other crazy ideas that you create are going to go into your next business once you exit.
Yeah. Yeah.
Find out who you are, master that, and then watch your dollars spent. So I would keep a spreadsheet with three columns. I spend this dollar and it A, grew revenue, B, it increased efficiencies or reduced cost, and the third column being it's going to be removed when I sell the business.
I like
And
that.
that's starting to build out your story to be able to tell it to a potential buyer.
I love that. Yeah. Folks don't realize how important the trailing 12 months income statement is and that EBITDA. So those not discretionary, but those non-essential expenses, the wasted dollars in your analogy, are super important. So thanks for calling that out. So Grant, thanks for being here on the Power Exit podcast today. Where can people learn more about you and your work if they want to connect?
Sure. So I have a website. It is www.grantthecfo.net. It's what happens when a finance guy does marketing at nighttime. He creates his business simple by his own name. So again, that's www.grantthecfo.net. And or you can contact me directly at grant@grantthecfo.net.
Awesome. Well, Grant, thanks for being here. It's always good to spend time with you. Thank you so much, my friend.
Thanks, John. Have a good one. Bye.
You too.